Hello traders, I'm Cam Mitchell, founder of Trade With Me, and today's topic is bar analysis, or what's commonly known as form reading. So if we have a look at what I've got going here, we've got form reading, and with every technique, as I've mentioned earlier, I ask myself, who is in control? Form reading is another way of asking who is actually in control on the chart. So let's look at what types of analysis we have first. What is bar analysis and why is it important? Well, bar analysis is the analysing of prices which has been plotted into a visual form. So we've seen prices before, which are just numbers, but we can now put these numbers into a chart form and it can tell us, again, what the buyers and sellers are thinking. It gives us an insight into what the buyers and sellers are thinking or feeling, but really, most importantly, it tells us who's in control. If we trade with who's in control, that increases our probability. So there's several types of charts, but the main ones that we look at are, the first one is what's called open, high, low, close. So this here is what's called a bar. It's a representation of all of the prices during that time period. Now, we don't have a time period here, so this could be a 1 minute bar, it could be a daily bar, it could be a weekly bar. Now on this bar here, what we have is we have an open, which is always on the left-hand side. We have the high of the bar, we also have the low, and we have the close. So we have the open, high, low, and close. And those are all the prices during that bar time frame. So on this occasion, the bar is green. So this is a positive. It means it is opened low and closed high. If we look at the next bar, we have the open, the high, the low, and again, the close. But in this case, the open is up here and the close is below the open. So that's what's seen as a negative or downside. And in this case, I've done it as red. Now people can do different colors for up or down, but the general colors you'll see are green for up and red for down. So here's an example. Here's an actual chart. And you can see on this side here, we have the open, the high of the bar, the low, and the close. Okay, so this is a standard chart. This is called CSR. This is a daily bar, a daily chart. And this bar represents all of the prices during that one day. Another type of bar that we have is what's called a candlestick chart. These are quite popular because they do certain types of patterns. Now the difference between an open, high, low, close and candlestick is you can see that it's quite visually different. It has what's called a candle or a body. You still have the open, you still have the high, the low and the close, but instead of having all this section here vacant, you actually have a whole body. On this side, for a downside, you still have the open, the high, the low and the close. And of course it's red because it's opened high and closed low, but visually it's very different. It has a body to it. Now, here's an example here. Same as before with CSR, we had the open, high, low, close. We still have the open here, the high of the bar. This is what traders call a wick. Okay, now this is just some stuff that you can look into in the future, but the basics of it is that we still have the open, the high, the low, and you can see the close is here. In this case, it's strong because it opened low and closed high. Another example is what's called a line chart. You'll see a lot of these in newspapers, maybe even on TV. It's a very basic way of looking at what the chart looks like. What this does is it just shows the close price of each day. So it doesn't show the open, high or low prices. It only shows the close price. So all of these prices here are representing the close, and that's just combined it with a line. Here's an example here. So if this is the close of each day, it's just represented in a line chart. You'll see that most traders tend to use open, high, low, close or candlesticks. There are many other types of charts that are out there, swing charts, Renko, all those sorts of things. But the general consensus is most traders will look at something like an open, high, low, close or a candlestick chart. Why is that? What does it mean? Well, this is the great thing about bar analysis, is it gives us a real insight into what the buyers and sellers are thinking or feeling. In this case, we opened low and we closed high. This indicates strength. Okay, we've opened low and closed high. In this next example, we've opened low, we went all the way up to this high, but then the close was actually halfway down the bar. That is telling us that there is some weakness there, that when the price got up to near the high of the day, there weren't enough buyers to keep pushing up the price, and then there was a sell-off. So that's indicating weakness. We opened low and we closed back down halfway through the bar. In this case here, we have what's called a neutral, where it opened and closed approximately the same. In this case, we still would have had the open and close slightly different to each other, which is why it's green in this case. Okay, now in the next example, we have a down scenario. So we have strong, weak, and neutral again. We have the open, we have the high, we have the low, and we have the close. In this case, we opened high and closed low, which indicates strength on the downside. So that is good if you're looking at going short or trying to profit from the market going down. Weakness is if we open high, we have a high, we then have a low, and the close did not close down near the low. It actually came back up and closed halfway up the bar. That is indicating weakness. It means the buyers came in at the end of the day and pushed the price up, and when it closed halfway up the bar. Same as before, neutral, we have the open and the close approximately in the same area, which means no one's really winning. The open and the close were the same, the buyers and sellers are the same. So here's just a final example that we have of what the market actually looks like. You can see these bars here, they're actually quite small, and it looks like there's really nothing standing out. There's no one in control. But we have an example here where we opened low and we closed high, and then it went into profit. Same on the short side here. We have nothing really happening with these bars, very small, no one in control. We then have a very strong bar here in opposite fifths, opposite thirds. We opened high, we had a high, we came down here, we had a low, and it closed right near the low. Again, if we're closing near the low, that indicates strength. On the downside, it means the sellers were lowering their prices throughout the day. So that's a basic interpretation of form reading. Go and have a look at your charts now and look at all these strong bars that stand out where it's opened low and closed high. Have a look at the bars where they closed weak, and then see what they did afterwards. If you have any questions, please send me an email to the email address afterwards if you'd like me to do any topics. Otherwise, I will see you in the next video. Thanks very much.